A little too hot for the Fed,
sure.
But also underscores how resilient the economy has been in the face of all of this move from the Fed, right? 300 basis points since the beginning of the year, 4 consecutive 75 basis point moves, and yet we're still creating a lot of jobs. Now, I get that it's a lagging indicator, but Neil Kashkari sort of weighs in this afternoon, tells the AP, he, of course, the Minneapolis Fed president, that tells me we have more work to do to try and cool down the economy and bring demand and supply into balance, suggesting, to your point, does nothing to take them off their path.
Yeah, but mind you, Neil told us nothing today that we didn't already know. Whether it's 50 or 75 in December is largely irrelevant in the sense that they're going to do more.
What if it's 25? What if it's 25? The Boston Fed president says you got to slow the pace, perhaps 50 or 25 next time.
Yeah, I think 25 at this moment is an outside possibility. I would not bet on 25, but certainly the conversation turns towards a slower pace, perhaps 25 at the late January, early February meeting in the beginning of the new year. Listen, again, what we're talking about now is largely irrelevant. Is it 50 or 75? Is it 25 versus 50? The point of the story is rates are going higher. The 2-year has priced some of this in. The 10-year, I think, probably has not. And then the question becomes, can stocks or can risk assets in general perform well if you have another 75 or 100 basis points of additional Fed tightening and the commensurate decline in economic activity that's presumably, although not assuredly, going to accompany it.
Okay, so hold that thought, because I do have some breaking news that I want to get to related to the Fed. Our Leslie Picker has that. Hi, Leslie.
Hey, Scott, it relates to the Fed indeed. The Fed releasing their biannual report on the state of financial stability. The overall headline of this very long report is that the Fed believes the financial system is stronger than it was, say, in 2008, and in many ways stronger than in the months leading up to the pandemic. Fed Vice Chair Lael Brainerd said in a statement that, quote, indebtedness has remained stable and, quote, on average, households and businesses have maintained their ability to cover debt servicing despite rising interest rates. However, she added that, quote, rapid synchronous global monetary policy tightening, elevated inflation, and high uncertainty associated with the pandemic and the war raises the risk that a shock could lead to amplification of vulnerabilities, for instance, due to strained liquidity in core financial markets or hidden leverage. Now, the Fed looks at a framework of 4 key vulnerabilities, potential vulnerabilities: asset valuations, borrowing by businesses and households, leverage in the financial sector, and funding risks. They say in the report that asset valuations have come down since the last report 6 months ago in May and become notably more volatile. The banking system remains well capitalized, as the Fed said during the stress tests over the summer as well. The Fed said short-term funding markets continue to have structural vulnerabilities just given the high uncertain economic outlook, but said funding risks at domestic banks are low at this time. The Fed also included a survey of 26 outside experts for what they see as the biggest risk over the next year and year and a half. The top cited risk was persistent inflation and monetary tightening, Russia's invasion of Ukraine, and volatility. So perhaps some signaling to the Fed in that survey, Scott.
Yep, Leslie, thank you for that breaking news. Leslie Picker on that for us. So back to you. Okay, we know consumers are borrowing more. They're spending more on their credit cards. So far, the debt service, not much of a problem. And one reason could be, as Axios tweeted today, Americans still collectively sitting on $1.7 trillion in excess savings built over the pandemic. That's one reason why the economy has been able to maintain its resiliency in the face of 300 basis points worth of hikes from the Fed.
I mean, listen, when you listen to the companies that have reported that are consumer-facing, Yum Brands said basically globally we see no issues with respect to the consumer. American Express said, hey, we hear everything you guys hear, but we see no change in behavior. Visa said we see something of a change in behavior, but total spending is doing fine. Booking Holdings and Live Nation, which obviously the stock didn't have a great day, but average ticket prices are up 17% and they're selling more tickets than they have ever had before. The consumer, by almost all accounts, is doing phenomenally well. It's an important part of why the economy is holding up as well as it has. But again, going forward, as this continues to worsen, that is the labor market, we're probably going to see a shift in that narrative.
Hey, what happens if we're on the precipice of a Fed fight? Every decision of late has been unanimous. What happens if you start to get a real contested decision in the room. Boston Fed president I mentioned today. You've got others who are saying hold the line. This is evidence, the jobs report today, and maybe to some respects the rally that we see in stocks, evidence that we need to keep the pedal on the floor. Any implication for how investors should be thinking of a more contested room?
No, listen, to borrow a phrase that's used way too much, I mean, the easy money's already been made, so to speak. You knew you had to get the Fed funds rate up. You knew you had to tighten financial conditions and contract credit somewhat. The easy work has been done. You couldn't be at zero. You couldn't be buying mortgage-backed securities. Now the hard work begins. How much pain are we willing to tolerate? How much pain are we willing to cause in order to help bring down inflation to the extent that we think that the Fed actually can bring down inflation?
Yeah, but you may have differing views in the room.